I think everyone should understand why they own what they own. And what that means is you should have a reason. What purpose is this fulfilling in my plan? I own gold because I'm trying to keep up with inflation, or whatever the answer is. You should have an answer for why you own what you own. If you don't know, then it's probably not the right investment. The good news is we're a fiduciary firm. We're open-minded.
Mm-hmm.
There are a lot of firms that would say, nope, don't do this. Don't ever buy that. Don't ever do this or that. There is no such thing as a bad investment. The plan determines the products. Let's find out where it fits, and we'll try to fit it in there.
Hello and welcome to Simplify Your Retirement with Stephen Strickland from Wise Wealth. Hello, Stephen.
Hey, Paul. How's it going?
It's going very well. You know, it's hard to believe, but we're wrapping up another season of the Simplify Your Retirement podcast.
Season 5.
Yeah.
Get ready to be in the books. Each one of our seasons has 12 episodes. So This is number 60.
Yeah,
unbelievable.
So we're trying to make it easy for people to binge listen to or binge watch it, as we now have this on YouTube. So this was, even though we have 60, this was our first full season on YouTube as well.
On YouTube, doing it by video.
Yeah, so it's been a good experience to be able to have that too.
Well, it's cool. 60 episodes. There's 52 weeks in a year. So literally, if you watched or listened to or watched one episode a week, there's more than a year's worth. It really is amazing.
Yeah.
Year's worth of content out there for people to listen to and watch. It's exciting.
Yeah, so it's been great. And, as we wrap this season up, we have a couple things we want to accomplish today. The first would be we want to kind of just recap again what we talked about in the season. So if someone's stumbling across this for the first time, or it's been shared with them, they've never watched or listened, they can kind of know what to look for over this past season that we've talked about and just kind of put a bow tie on that. But then also throughout the season, we do get questions.
Yeah.
So we get questions from people emailed in, questions asked. And so we want to take a little bit of time and talk through some of these questions that people have and let you answer them. The best part is for those of you watching and listening, Stephen's never seen these questions. So
yes,
I am the keeper of the questions.
He has all
I
the
have
questions.
the questions here.
I have no notes. It's just me. It's just me over here. We'll see how I do with these questions. I'm excited about this.
Yeah. So we're going to walk through some frequently asked questions. Okay. Obviously, these are we've come across these types of questions before, but it'll be good to hear the unscripted answer as we head into this.
I'm excited to hear it too.
So, this season we focused on really what we call the 7 areas of retirement planning. And so we broke it down into 3, 3, and 1. So what are the first 3 areas of retirement planning that we focus on?
Well, first I would just say that the entire package, if we want to call it that, is called the Retirement Freedom Plan. So the bow around the entire planning process is freedom. It's freedom planning and the freedom to be able to give, serve, and enjoy life. And so in order to be able to do that, we have 2 areas, like you mentioned, that have 3 categories under each one. The first one is income planning. Income planning covers a liquidity plan, an income plan, and a growth plan. We believe that this is the foundation. We believe this is what everyone needs to start with in order to have peace of mind in retirement. We also believe that this is an area of focus for a lot of financial advisors. Most financial advisors will at least focus on how much you should have liquid, how you should draw an income stream, how you should grow your assets. Most financial advisors aren't taking it to the next level, which is impact planning, but the first 3, liquid, income, and growth. And we use what I would just say is a proprietary 3-bucket approach. There's other companies, other firms that have 3 buckets. Ours are unique, and we have a process where we fill these buckets one at a time: liquid, income, and then growth. And that really is an area that leads to literal peace of mind, confidence in retirement. That's what we want people to have. Absolutely.
And I know that we have several episodes on that. So if you're listening for the first time, go back and watch the beginning of this season. You'll catch specific episodes on each of those individual topics. But you're right. It's retirement planning obviously is kind of a broad category, and a lot of people focus on it, and you see them everywhere: retirement dinner seminars, retirement seminars, retirement workshops, retirement. But that's in a sense like the tip of the iceberg. That's just the part that people see. And so we want to go deeper than that. And so we say, once you have that set, that is important. You have to start there. Yes.
Yeah.
So let's address the
Right.
800-pound gorilla in the room. But as we walk through that, we believe we have a unique approach to that. But let's also go deeper. And so what are the next 3 areas of planning?
So outside of income planning, then there is impact planning. We know that you just said that retirement is more about than getting to a destination. It's about getting through your entire life. And so we believe in not only just getting a return on your investments, but a return on your life. And so in order to be able to do that, to really make an impact, really to be able to focus on what you want to do in retirement, impact planning involves legacy planning, which your wills and trusts, powers of attorneys, beneficiary designations. It involves insurance planning, making sure we have Medicare set up properly, life, long-term care, some of the biggest risks people face in retirement, and tax planning. All of these things are important once you get the founding, once you get the income plan in place, you get the impact plan in place. Now all of a sudden you have 6 areas that are completely planned out. And you and I have talked about this for 59 episodes. Okay, and it's not a plan unless it's written down, unless it's a process, not just something in your head. And so when you have a plan for how your money should be invested, for liquidity, for income, for growth, you have a tax plan to minimize taxes. You have all your insurances covered. Your kids are taken care of. Your beneficiary designations are in place. Your powers of attorney are in place. You have these 6 areas done. Guess what you have? Freedom. And that's the entire thing, the retirement freedom plan. Freedom to give, serve, and enjoy life. Freedom to get through retirement, not just to it, being able to do the things that you want to do. And so that's why it's been great to really go to a deep dive in this series and really all 7 of these areas.
Yes. And, like we said, the retirement planning is the tip of the iceberg, and then we go deeper with the impact planning, and then we go deeper still with the freedom planning. Yeah. And so a lot of great information out there throughout this season, and appreciate you taking time to walk us through all of that this season.
And I just want to say, again, that we not only do we, but say that this is what people need, but if someone is listening to this for the first time, Wise Wealth was built to do this. In other words, we have people to help our clients through each one of these areas. We have a CPA on our team to help with tax planning. We have a legacy planner to help with wills and trust and powers of attorneys. We're not saying, hey, you guys need to go get all these things. We can help people with long-term care insurance. We can help people with Medicare. So our firm was built not only to get people to retirement. And I know that when someone hears this, think, well, all firms are like this. I wouldn't say it if all firms were like this. A lot of firms are help you to get to retirement, but we are focused and built to get people through retirement with a relationship so that people are free to do things they saved and invested and planned for their whole life. And so we're not saying here's what you need to go do. We help people through this process, and we have people here to help in each one of these 7 areas through the process.
Yeah, and that's because it's not transactional. So sometimes people say we're not transactional because we have a plan and we don't focus on product. But yet a lot of plans that I've seen or come across, unfortunately, are a one and done type of plan, right? Yep. Hey, let's set it in place and you're done. Right. But if we think about, if I think about my fresh out of college self and where I am now, it's certainly not where I imagined I would be. A lot of life has happened. Yeah. When you think about spending 30 years in retirement, to say the plan that I put in place at the very beginning is exactly the same 30 years later. Well, no, so it has to live and breathe. Yeah. And so I know in some of the classes that you've taught and some of the presentations you made, we kind of talk about it almost like a wheel that's kind of propping everything up, because we don't know what's going to hit you at any point in time. Yep. Right. So throughout your retirement, the focus may be taxes, it may be insurance, it may be legacy, it may be income, it may be growth. We don't know what's going to hit you at any given time, so we have to be able to adapt, and having the team here to help you get through retirement is critical.
That is absolutely critical, and like I said, that's what we're built to do. We're not saying go do it. We're going to be here throughout that journey, throughout that process, and so it's been exciting to talk about it during the season. And really, this is what we do each and every day: live it, help people do it, and for the ultimate goal of freedom. And certainly, anyone can go back and listen to these episodes to find out what we mean by that.
Yes,
making work optional, freedom, from fear and anxiety and frustration, freedom to give, serve, and enjoy life. That's what we want people doing in retirement. And unless you deal with these 6 areas, you're not going to be able to do that. That's what we know. So we're trying to take all of this stuff off the plate of people and say, here, we have a plan for each one of these areas. There's really nothing else to worry about. Now go do what you need to do in retirement. Don't waste the next 30 years of your life in retirement being fearful or frustrated about all these things you could have dealt with. And certainly just leaving your retirement to the whims of the stock market, to asset allocation models. There's more to it than this. And we are fiduciaries. We're risk managers. We want to help people get to where they need to be in retirement with the least amount of risk as possible.
Yeah. And so, not to confuse people, it's going to sound like we're wrapping up the show, but we're just wrapping up this section, in a sense, the season. So we want to put a bow on this. And so what I would say to anyone watching or listening right now is, if you have not taken action, if you do not have a plan that gives you the freedom to give, serve, and enjoy life, to make work optional, and to enjoy the retirement years, you need to give us a call. Take action. It's simple. 816-246-WISE, 9473, 816-246-WISE. Give us a call, and it starts with one simple step. We meet for a clarity conversation where we get clarity around what retirement looks like to you and where you're at in relation to that right now. And then we start the process of putting together a retirement freedom plan for you. So give us a call, email us at info@wisewealth. Either way, take action, and let's start that process.
I would also
today.
say, the whole name of the show, the book, Simplify Your Retirement, we're trying to make this simple for people. We also have just an 8-question quiz to see if you're ready to retire. You can go to our website, wisewealth.com/quiz, wisewealth.com. There's a quiz right there. You can also take that too, 8 questions, and that'll help you figure out if you're on track.
Absolutely. So, as we wrap this up, though, now we want to shift a little bit here and
Q&A.
have a little fun. And so there are some questions, and these are great questions, and we do hear them a lot. So I think it's great to be able to walk through this and do this. And so some of these were very similar. So like this first question here is kind of, I've reworded it a little bit because there were several like this. Okay. But basically, it goes like this. What do you think about owning blank in my accounts? Or what are your thoughts on investing in blank? And so we've heard everything from, say, commodities, gold, silver, to REITs, to Bitcoin, annuities, life insurance. So whatever product someone brings up, let's put that in there. And so what are your thoughts on owning this type of product in my account?
So anytime we hear a question that's specifically like, is it okay to own this? Should I own this in my portfolio? The answer to the question that always comes to mind first is, there is no such thing as a bad product, only a bad fit. And what we mean by that is every single thing you can invest in has merit in and of itself. But what determines whether or not I should own it or not depends on what is the purpose of it in my portfolio. What purpose does it fulfill? Where does it fit? You can find out a piece, sometimes talk about, you might listen to the radio or TV and find out they're selling raw land and wherever, and it sounds like a great deal, and it may be a great deal. But if it doesn't fit your need for liquidity or fit your need for growth or for income, then that means it's not for you. It may be for somebody else. So whether or not this or that thing is a good investment or not, is not really the question. And the question is, where does it fit in your portfolio? Is it providing you with liquidity? Is it producing an income stream for you? Is it allowing you to grow your assets with enough liquidity? So that's my first answer. There is no such thing as a bad product, only a bad fit. So then we have to look at it and say, what is the product? And then what do you already own? What would this replace? Is this better than what you might already have in your portfolio? And so typically when people are asking about a specific type of investment, it's not because they woke up one morning and just, it came to their mind. It's because they heard an ad on the radio, they saw an ad in a magazine, they were talking to a buddy at work, whatever the case may be. It's somebody who is selling this thing, and typically advertisers do very well. They wouldn't be in that business. They cause us to want something, whether we need it or not. Certainly, I think all of us can relate to that. We've all bought something that we thought we needed because the advertisement was so good. Okay, so the same thing happens with investments, whether it's gold, real estate, commodities, Bitcoin, whatever the case may be. So I'm here to say the answer to that question is always difficult, because the answer is not, no, you don't need that. The answer is not, yes, you need that. The answer is, let's find out about how this thing works and where would it actually fit and what are the alternatives. That's how you determine whether or not that's the right investment or not.
Sounds like there's a principle behind that.
Yeah. The plan determines the products.
Yes. And so,
absolutely.
So we are a principles-based firm as well. And so we have principles that we hold to.
Right.
Because principles don't change.
That's right.
And that's it. And so it is interesting to see how many times we meet with people and we say, okay, what's this for?
Yeah.
I don't know.
Right.
Why do you have this? I don't know.
I don't know.
And so people own a whole bunch of stuff.
Absolutely.
But they don't know why they own what they own.
Very important. Yeah. I think everyone should understand why they own what they own. And what that means is you should have a reason. What purpose is this fulfilling in my plan? I own gold because I'm trying to keep up with inflation, or whatever the answer is. You should have an answer for why you own what you own. If you don't know, then it's probably not the right investment. The good news is we're a fiduciary firm. We're open-minded. There are a lot of firms that would say, nope, don't do this. Don't ever buy that. Don't ever do this or that. There is no such thing as a bad investment. The plan determines the products. Let's find out where it fits, and we'll try to fit it in there.
Yeah. And so I think that goes along with another question here that a lot of times we get these kind of in tandem in a sense, right? So especially when it comes to gold and silver, which are the very common ones we hear from, what do you think about gold? What do you think about silver within my portfolio? And someone asked this question, what is your view on digital or cryptocurrency? I'm wondering if I should start transitioning to this for myself and what it means to my investments if the dollar goes away.
Yeah. Well, so, it's funny, the last part of that, because, if the dollar goes away, I mean, some people are worried about what is the dollar based on. I would ask that same question about what is cryptocurrency based on. So still it's a new, certainly the technology behind cryptocurrency, blockchain. This is where we understand that the blockchain technology, that's here to stay. There's a lot of purposes for it. Cryptocurrency. Just like coin currency, or just like fiat or dollar bill currency, it's all has an underlying value. The reason why people like gold is because it does have an intrinsic value. At some point, the value of the ounce of gold or a pound of gold is worth something, regardless of what the market says about it. The dollar is worth something. Unfortunately, it's not tied to gold anymore, but the dollar is worth something because everyone says that it is. And it's the world's reserve currency at the moment. Cryptocurrency is worth something. Bitcoin is worth something because everybody says that it is. It has no intrinsic value. I can't melt it down and convert it into something else. It is something digital. So if you think about this, a digital currency, there's a lot of risk there. It's, first of all, it's digital. It's not tangible. You can't hold it. You're never going to see it. It's not something you stick in your pocket. It's not something you can stick in your safe. It is a computer-based model, and it's a currency, which means as long as it has some value of exchange, it could be worth something. So let's go back to the question before. Should I own Bitcoin in my portfolio? Okay, well, let me ask you a question. Is Bitcoin, you want to use that as a liquidity? Is it for liquidity? Do you want Bitcoin to produce an income stream for you? Probably not. Do you want to own Bitcoin because it's part of your growth portfolio? That's a possibility. That may be where it fits. Is it an investment that that you can, to me, it's more of a speculation. It doesn't mean that it won't work. It doesn't mean that it won't make money. It just means that it needs to be properly viewed. Mm-hmm. It probably needs to be in a pile of money that you don't intend to touch for 5 years or longer. So it's a long-term investment. It's not a short-term investment. It's not an income-producing investment. It is for growth. So if someone wanted to allocate some of their assets to something that is speculative, is that wrong? No, but there should certainly be a limit on that. That's what we look at. Here's a couple of things that I do think about when I think about gold, silver, digital currencies, and that is a lot of times these investments are sold or they're analyzed under the lens of fear and greed. Mm-hmm. And so we would just say to people, look, that's not how you make an investment decision. That is not a wise way to make decisions based on fear of missing out or fear that if I don't do this, the dollar's going to crash, or of greed. I want to make sure I get in here because the normal plan, here's what I would say to everybody, have a plan that takes care of you throughout retirement. And there's still disposable assets to do some of these things. We're not opposed to it, but have a plan first. Don't make a decision based on fear and greed. Here's another one. Don't make investment decisions based on what someone else is doing or say that they're doing. Okay. Everyone has an opinion about the investments that they own and why it is the best thing for them to do and therefore for everybody else to do without knowing your situation. Mm-hmm. Maybe some people should own Bitcoin and maybe some people shouldn't. Mm-hmm. Is that okay? In other words, is it okay for some people to own gold because it fits in their portfolio and some people not? That's the problem.
Yes.
It may very well fit for some people, but don't make the mistake of owning something just because someone else does and just because it's working for them or has worked for them.
Yeah. Yep. And the fear and greed, that's what I was thinking of. And then you went there, but it was, that's the two most common ways that people buy.
Make mistakes too, right?
And they make mistakes. But I mean, that's, for many people, that's the way they do it. Yeah. And sometimes they go hand in hand. So FOMO, fear of missing out, is ultimately about greed. Yep. But fear-based, I mean, that's just, we have to plan for what we know. Yeah. Right? And so there are some unknowns, and we have to be able to address it, like sequence of returns. Will sequence of returns risk impact you? Yeah. Okay. It may or may not. Right. And we've talked about sequence of returns risk, but the fact is it does impact people. Yeah. It's not guaranteed to impact everyone. Long-term care is not guaranteed to impact everyone, but we see that it impacts people. It's a true risk. We have not seen the dollar collapse. That's right. In the whole fear of the dollar collapsing, the only thing I would say to people is that, right now the U.S. economy is based on the dollar. A lot of the world's economy is based on the dollar. The entire, a market-based system, Wall Street's all based on the dollar. There's a lot of people that are vested in the U.S. dollar. And so this whole concept of people trying to sell people current, let's say, gold and silver commodities because the dollar is going to collapse. We've been hearing this for not years, decades. The dollar's, and it may. One of these days, someone may be right. Yep. But here's the thing. The value of the dollar is going to have to be converted into something else. It's not going to it's nothing. It is, if we're going to go to a digital currency, then they're going to translate the dollar. $1 equals a certain amount of digital currency. That's what I believe is going to happen. It's not just going to be like, sorry, it's worth $0 now. I don't think that's going to happen, but that's the kind of the doomsday. That's what people think. The dollar is going to be divided. The dollar is going to go to zero. Mm-hmm. Well, it's got to be converted into something that's more likely. Yeah. And, the fear and the greed drive people, but that makes me look at the second part of a question. We'll go back to the first part in a minute that someone had, but I broke it out into two parts because what they say really has two different aspects to it. So let's focus on the second part of this question first. And it was about their 401k. And they said, also, why would I want to pay fees to work with an advisor when I don't currently pay any fees in my 401k? Yeah. Oh, yeah. Thank you. The 401k has no fees. I love this one because this is a fallacy. Mm-hmm. People believe because if they don't see it, they're not paying it. And so certainly there is no such thing as anything that is free. There's no investments that you can own that are free. What people mean when they say, hey, in my 401k, I'm not paying any fees, it's because they're not paying a fee to have their portfolio managed
It does not mean that there are not fees associated with that 401k, that there's not expenses coming out before they're getting their returns. Certainly everything you own, if you're invested in mutual funds or ETFs, there are internal expenses of these things. And so I always tell people there's a difference between a fee and a cost. A fee is what you can see. A cost is what you can't see, but it comes out of your returns. And so I believe I think we have an episode literally on this topic. And I think one of the 60 episodes is on this fallacy that in my 401k, I'm not paying fees. But you just don't see them. It's a cost that you don't see. It's not a fee that you can see. And so it comes out of your returns. So a lot of times what we see is your returns might be better after paying a fee than the portfolio that you're in that you're not paying a fee. Because a lot of times the cost of the funds, the cost of the administration is higher. And so the point is not whether or not you're paying a fee or not paying a fee, it's what are your returns that you're getting in exchange for the fee. And this leads me to another point, and that is a lot of people that aren't paying a fee, let's forget the 401k for a minute. Hey, I'm not paying a fee, I'm saving 1% a year. Well, a lot of times what their returns are lower because of what we call behavioral finance. People tend to be emotional investors. And there's been studies that have been done that show people that pay a fee, their returns tend to be higher if they're the right kind of coach because they encourage you to stay disciplined. Where in your 401k, it's easy to move stuff around because you're not paying anybody. No one's managing that for you. You're not paying anybody a fee to look at for you. You're going to try to buy and sell and get it out. And it just costs more. Our own behavior costs more. Sometimes the funds cost more. And one other thing I want to say, since you brought up the 401k, I've been thinking about this lately. It's been one of my things. And sometimes someone will tell us, look, here's my 401k, my poor 401k. And this is not about fees. I'm going to go off the script for a minute. Sometimes people will say, I'm invested in an IRA, through your company at Charles Schwab, let's say an IRA, and I've got a 401k. They're kind of invested the same way, but my 401k is outperforming the IRA.
That's actually the first part of the question.
Okay, thank you.
Yes.
I'm going to go how is my 401k outperforming the IRA? And what bothers me about that is that if we're in the same stock market, the 401k is in the same market as the IRA, and you're in the same types of investments, it's not possible really for the 401k to really outperform the IRA or vice versa. The reason why 401ks seem to be outperforming IRAs is because two reasons. One is you're adding to the 401k in most cases. Sometimes the IRA is stagnant, you're not adding anything to it, but the 401k, you're constantly adding every payroll. That's number one. Number two, most 401k providers add your contributions into the total return. So you started with this much this month, you have this much at the end of the month. Forget the market, what it did. It's taking into account your contribution. So your portfolio, your balance is up a certain percentage, but that includes your contributions. That is an absolute pet peeve of mine, and because it always makes it seem like the 401k outperforms my IRA. Yeah. We're in the same market, same type of investments. The market's going to do what it's supposed to do, and it's because of your returns are mixed in there. So keep that in mind.
Yeah, and that was the question that they actually had.
Okay, yeah.
Yeah, and I know that when I've looked at them too, I love the marketing aspect of what some of the statements do, right? Your personalized rate of return, right, is what they'll call it.
Seriously,
yeah.
It's these semantics, these word games people play. So it's not your investment rate of return. You can go to that in the prospectus somewhere and look at each one of the funds and how they performed, but your personalized rate of return normally includes your contributions.
And there are a lot of great things about 401ks.
Yeah.
It's not that 401ks are bad.
Yeah.
But it's not a fair comparison.
That's
oftentimes.
Right.
And that's what we want to highlight here.
Definitely.
So.
Yep.
Yeah. And so, working with an advisor though, the fee is really, you're paying for advice and you're paying to protect yourself against yourself. And a lot of times, you know what I mean? Because advisors help people stay disciplined. Yeah. They help them from making rash decisions based on fear or greed, because that's where people make mistakes. And
the majority of the time, the biggest hindrance to success in investing normally is the person we look at in the mirror. that person is the main reason why we're not successful most of the time.
Yeah.
We get in the way. And so you need to have an advisor. You need to pay someone a fee who can not only build a portfolio for you that's customized, that's diversified, but also encourage you to stay disciplined, more of a coach. And that's really one of the biggest jobs we have here. But especially in our context, we started the show with the 7 areas of financial planning. For our fee, clients are getting all this stuff, not only the investment management, but also the tax planning, the legacy planning, all those things.
And so here's another fun question. This is in relation to returns as well. It says, I watch the news and see what the market's doing, but I don't see those types of returns in my portfolio, and it's invested in the market. Why is that the case?
So they're watching the market.
The market, yeah.
Yes, I love this question.
We get a market update, you know?
Exactly. So I love this question because, people tend to say, hey, the market is up, my portfolio is down. Well, a lot of times when that happens is when they say the market, first of all, we have to define what in the world does that mean. Most people, when they say the market, they mean the U.S. large cap stock market. They mean the S&P 500. They mean the Dow Jones. It's all over the news every day. So if you look at the S&P 500, the U.S. largest 500 companies. So it's all U.S., it's all large cap stocks. So that is one piece of an overall pie. That's one asset class out of many asset classes. So when people are saying the market is up, what they're saying is that one asset class is up, but my portfolio that owns maybe 12, 13, 14, 15 different asset classes is down. Well, of course, if I own one asset class, my risk is going to be way high to own only one asset class. My standard deviation score is going to be off the charts because I only own one asset class. I'm not protected on the downside. When you own a diversified portfolio, you own that one asset class. So we always tell our clients, if the market is up, and by the market you mean the S&P 500, what should be, the benchmark for that, what should be, taking those same returns is you look at the portion of your portfolio that is U.S. large cap stock. That portion of the portfolio should be equal to whatever the market is doing, the S&P 500. But it is important. Everybody wants a diversified portfolio during times of volatility. Everybody wants a diversified portfolio long term, but what they don't want is the S&P 500 to be outperforming their portfolio. But the amount of risk you take, the downside of owning just one asset class is too great for people normally to handle the downside of that. So you build a diversified portfolio. A diversified portfolio has U.S. large cap, it has U.S. mid cap, it has U.S. small cap, it has emerging markets, it has international, it has bonds, it has all of these things. What does that do? It minimizes the risk. It lowers the downside. It kind of standardizes the return. So you get a smoother ride over time with less risk. So when we say the market, we just have to be careful with defining what market are we talking about. And normally it's U.S. large cap stocks.
Yeah. And I know you've done a great video on this before, and so we'll try to link that in the show notes.
Yeah.
It's a quick little video, but comparing like an apple or an orange to a fruit basket. And so it's about the benchmark. What is the benchmark that you're comparing it to?
You're going to need to have a benchmark, right? You can have a portfolio of all apples, which is the S&P 500, or a nice fruit basket that has bananas, oranges, apples, grapes, all these things. And like I said, we have a video on that. Most people want the fruit basket, not just one type. Even though sometimes, but you own the apple inside of your diversified portfolio. You own the market in this one. And really, that's what you need to be focused on. You need to be focused on the returns of the portfolio, not one asset class. Because then the other thing happens, sometimes we'll hear that, emerging markets are going crazy or international. So we want to this is the problem with the industry. Everyone wants to buy and sell, get in, get out, overweight, underweight, constantly move things around. And we know that, own all of these pieces of the pie. We've looked at this a million times. Every asset class has positive returns over long periods of time. So the way to make money in the stock market is own all the asset classes and hold them all over long periods of time. The only thing that can get in the way of that is me and you. We say, I don't want this fruit anymore. I want more of this one, or I want more of that, less of this because it's doing well. And then we're always late to get back in. You can't ever time it right. You're going to be too late getting in the market or too late getting out of the market. You either need to be in the market or not, which is why we have what we call the 5-year rule. Only take diversified risk with money you don't need for 5 years or longer. Own the broad market, which is every asset class, and own them all for a long period of time.
Yeah. And speaking of asset classes, I know we're going to have to wrap this up here, but we have an interesting, fun little question for you here. Why are bonds called fixed income? I keep losing money in the bonds in my portfolio, and I thought they were supposed to be safe.
Yeah. Yeah, there's categories. There's equities in asset classes. There's fixed income in asset classes, and normally bonds are included in the fixed income category. But I kind of agree with this question. In other words, it's another semantic thing. Bonds are not fixed income. They're investments that are safe. They're low correlation with the stock market, but you're going to get an interest rate on these bonds. There's always a maturity date in these bonds, but they don't provide fixed income. The income is based on current interest rates. So I could buy a bond today that has a certain interest rate, but it doesn't mean that interest rate is fixed for the life of that bond. It could go up, it could go down based on other interest rates. So there's risk with every investment. And so, you want investments, if someone needs income that is fixed, certainly there are products that are designed and created to produce a fixed income. Bonds are not one of them. Bonds can lower volatility. Bonds can lower standard deviation of portfolio, but they are not going to provide a fixed rate of income, because it is based on interest rates. And so if that's what the need is, we find things that do that. Like we've said before, the plan determines the products. Make no investment decisions outside the context of a plan. So bonds, as interest rates have gone up, the value of them has gone down. They've not been a great investment really for a long period of time now. So there's other things you can do to protect a portfolio from downside risk than bonds. But certainly fixed income is not how I would define a bond. Yeah. Certainly it has an interest rate. It's not correlated to the stock market. It's more correlated to interest rates. So there is risk, but it's a different kind of risk, which is why it is nice to have in a diversified portfolio. The stock market goes down, the bond should technically hold up, because it's a different kind of risk. It's based on interest rates. So, but it is not fixed income. If someone needs a fixed income stream, that's why we don't do bond ladders. That's why we don't do bond portfolios for income. And there's a lot of reasons for that. It's more expensive. It's more risky. It's less guaranteed than other ways to do it, which is why we would say to someone, look, go to someone who can be objective and tell you, traditional financial advice says if you need income, you need more bonds. No, there's a better way to do this. There's ways to grow your assets better than having all your money in bond type funds that are not going to produce a good income stream. It's certainly not going to be fixed, and it's certainly not going to be guaranteed.
Yeah, and bonds are, even in the question in and of itself, it's interesting because bonds, what do you mean? Right, because there's individual bonds, and there's corporate bonds, there's junk bonds, and there's funds, and there's ETFs and mutual funds, and so it's such a broad category. Right. So again, going back to the principle earlier, there's the concept of there's no such thing as a bad product, just a bad fit. There's a place for it. There's a place for bond alternatives. There's a place for true fixed income. There's a place for bonds, bond funds within a portfolio, and so in and of itself, it's not bad. Yeah. But too much of any one thing is not great either. Absolutely. And the other thing too, I would just say just in general in the context of what we're talking about today is there is no risk-free investment. There is no one perfect investment. That's why we say it comes down to a fit. Anything you can invest in has its benefits and there's its limitations. There's not a perfect investment that can never go wrong. There's nothing wrong with it. It fits for everybody. There's no such thing. That's why it's very important to analyze and evaluate all these things. Do you really need income? Let's look to see what's available. Do you just need protection from downside? The stock market goes down. Let's look to see what's available. And it really comes down to, those kinds of things. It comes down to fit. There is no perfect investment. There's no risk-free investment out there. Yeah, and so I know that's why this season has been great. I mean, obviously, we have a lot of material out there, but one thing that's really been good about this season is, to me, it's reframing the conversation. So a lot of these questions that we got, and there's still more here, but we're not going to have time to get to them today. We're going to hold on to them for another FAQ session and all of that. But a lot of it is product focused.
Yeah.
And that's what the industry is pushing. That's what people know. I mean, I buy a product, I'm invested in something. And so we want to understand it. And so we talk to people and we listen and we hear and we learn and we do all these things, but it's all product focused. And we're saying, no, we need to flip the script. Right. Just like we say, let's reframe how we look at retirement. It's making work optional. We need to reframe how we look at products. The plan determines the product. So it's all about the plan, not about the products. The products are a means to an end. They're simply puzzle pieces we use to accomplish a goal.
Yeah, it's a very good point. You know, people are focused on products. And like we talked about earlier, all advertisements, marketing, Wall Street in general, they're incentivized to get people to do something. Don't just stand there, do something. And we tell people, look, sometimes the best thing you do is not to do anything, to do nothing. Keep what you own and keep riding it out and let the investments do what they're going to do over time. We're the ones who mess it up. So product focus is a mistake. It is natural. It is what people see. It's what they hear. It's what they look at. It's what that appeals to them. Everyone kind of always has this idea that we're missing out on something. It's like human nature. But to be content with what you own, as long as you know why you own what you own, as long as it's within the context of a plan. The plan is what provides financial peace of mind. That's the fifth principle. Financial peace comes from having a plan, not a product. There's no one thing you can invest in that's going to solve all your financial problems, your investment problems, your retirement dreams. Not one. It is the plan that determines it. And so like you said, Paul, we take a step back and say, look, we're focused on, all the products are available. We're not against any of them. We're for all of them. The plan determines it. So let's make sure we've got a plan in place first. Let's find the best possible products for each area that you need. And then be content. That's might be the message. And to let it do what it's supposed to do. Then stop being attracted by advertisements and marketing, these things, other products that people are owning, and feel like you're missing out on that. Make sure you've got a plan. Make sure you have a trusted advisor, and that's what we're here to do.
Yeah, so if you're tired of focusing on products, trying to figure out all the products that are available, and you say, I need a plan. I need the freedom, the peace that comes from having a plan. Call us at 816-246-9473. That's 816-246-WISE or info@wisewealth.com. And let's start that conversation, simple clarity conversation to start with. And let's get you on the path of having a retirement freedom plan for yourself. Stephen, thank you for the unscripted answers. This was great. Today.
I enjoyed it.
It's always valuable information that you provide for our listening audience. And, for you, our listening audience, you're the reason that we do this. Those watching this on YouTube, listening to it on your favorite podcast channel, you are the reason we do this. We thank you for these questions. Keep sending them in. We love to be able to answer questions like this. We try to do it throughout, but we do enjoy episodes like this where we're able to just take your questions. And so we do keep these. We keep them running so that we can address these from time to time. We try to do it within the content, but then even specific episodes like this. So send us your questions. We love hearing from you. Again, you're the reason we do this. So, Stephen, thank you. Yep. Thank you to you, our listening and viewing audience. Without you, we wouldn't be here. And so, again, this is Paul from Wise Wealth, reminding you that financial peace comes from having a plan. And we'll see you next time.